Okay, Assalamualaikum warahmatullahi wabarakatuh. I am Asyrafi Abrar farqi. You can call me Abrar. I'm here going to presentation about central bank credibility, monetary economics, and inflation. So the first we are going to talk about central bank credibility. Central bank credibility is defined as a commitment to follow well-articulated and transparent rules and policy goals. So, in essentially, credibility is a function of the difference between observed inflation and the inflation rate that the central bank targets. So there's a reputation and credibility are really important in the central banks. So the first is policy signals from policy signals from a credible. So central banks will be understood and generally accepted by market participants and the public at large. And the second was more efficient, more more effective monetary transmission mechanism and a lower cost of disinflation. So added to this is the anchoring of inflationary expectations by the public when it believes in the central bank's commitment to keeping the inflation low. And the last was, as lender of last resort would not necessarily trigger inflation expectation. So credibility also contributes to achieving financial stability through many channels. Real impacts will be felt only if banks respond to central banks measures and consumers adjust their behavior accordingly. Credibility can improve effectiveness of policy response to sectoral imbalance. Next. So is the factors that affect central bank reputation and credibility. The first factor was central banks are mainly judged by the public on the track record in achieving policy objectives. So public confidence can be boosted by the central bank's ability to monitor, assess, and manage systematic risk to the overall economy. It is important that clear regulations and rigorous supervisions are in place so that potential problems in the banking sector will be spotted at an early stage and prompt actions taken. Second was central bank credibility also rests on the ability to manage its own financial and operational risk. So central banks learns what they preach by adopting the same high standards of risk management prescribed to banks. But unlike private financial institutions, central banks are not profit maximizing entities, and sometimes the pursuit of public policies in fact inevitably entails financial risk and cost. And the third was sound and practical policies need to be complemented by good stuff with and ethics. So it is like we need to have a great employment with good competency and ethics. That's very important things. So next, we are going to go with monetary policy. So monetary policy, uh, the demand side of economic policy, refers to the actions or policy undertaken by a nation's central bank to control money supply and achieve macroeconomic goals that promote sustainable economic growth. So these policies are implemented through different tools, including the adjustment of the interest rates, uh, purch- purchase or sale of government is, and changing the amount of cash circulating in the economy. Monetary policy consists of the management of money supply and interest rates, aimed at aimed at meeting macroeconomics objectives such as controlling inflation, consumption, growth, and liquidity. So economists, analysts, investors, and financial experts await monetary policy reports and the outcome of meetings involving monetary policy decision makers. So decision makers is so important. Such development have a long-lasting impact on the overall economy as well as on specific industry sectors or markets. Next. So in this monetary policy, we can different it two parts. There is expansionary monetary policy and contractionary monetary policy. In expansionary, in expansionary, it will aims to increase the money supply in the economy by decreasing interest rates, purchasing government securities by central banks, and lowering the reserve requirements for banks. So in expansionary policy, an expansionary policy lowers unemployment and stimulate business activities and consumer spending. The overall goal of the expansionary monetary policy is to fuel economic growth. It can also possibly lead to higher inflation. Second was contractionary monetary policy, aims to decrease the money supply in the economy. It can be achieved by raising interest rates, selling government bonds, and increasing the reserve requirements for banks. So the contractionary policy is used when the government wants to control inflation levels. So the example of expansionary monetary policy, as we can say, is like decreasing the discount rate, purchasing government securities, reducing the reserve ratio. Next. So there's tools of monetary policy. Actually, central bank use various tools to implement monetary policy. There's a various things that can implement monetary policy. The widely utilized by policy tools is including. So this is the most tools that maybe appear in monetary policy was the first one is interest rate adjustment. Second was change reserve requirements, and the third one was open market operation. So in the interest rate adjustment, a central bank can influence interest rates by changing the discount rate. So they can change in the discount rate. So in the change reserve requirements, central banks usually set up the minimum amount of reserve that must be held by commercial banks. And in open market operation, central banks can either purchase or sell securities issued by the government to affect the money supply. So next we are going to talking about inflation. So inflation was the rate at which the value of a currency is falling, and consequently the general level of prices for goods and services is rising. So inflation, we can say, is the decline of purchasing power of a given currency over time. Quantitative estimates of the rate at which the decline in purchasing power and in occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. So the rise in the general level of prices, often expressed a percentage, means that a unit of currency effectively buys less than it did in prior periods. So the next, so this is what we can see in the inflation. There's a three things that maybe make you success to overcome the inflation. This is the key to overcome it. So the first one is demand pull. So it happens when demand for goods or services exceed production capacity. And second was cost push, when the production cost increase prices. And third one is built in, when prices rise, wage rise too, in order to maintain living costs. So actually, these three things was key when the inflation will might occur, and what will make you define your success is to overcome these three things. How to solve demand pull, cost push, and build in, and how to get the benefit from it. So maybe that's all from me. Thank you. Maybe that's all that I can give to all of you. If there is something wrong, maybe you all can correct me. That's why we're learning here, right? So thank you for the attention. Assalamualaikum warahmatullahi wabarakatuh.